I made $6,500 trading 0DT options last Friday. What's going on, guys? My name is Usman Ashraf and I've been trading options for almost 10 years. And I'm going to be breaking down a trade for you guys today. So on Friday, we had Oracle that gapped up almost 10 points. So on Friday, we saw that a stock that we were already watching, Oracle, had actually gapped up almost 10 points. And it gave us two setups. One was a gap and a go setup over 175 level, and the other was a gap fill under 170 level. So we had the alerts to keep watching both of the setups. So let me break that trade down for you guys.
All right, so as you guys can see, we're using TradeZilla to break our trade down. So just to give you guys a rough breakdown, the strike that I went with was 165 puts, right? And it was expiring on the 13th, which is 0DT contract. All right, and the net P&L on this trade after commissions was $6,367.82. This was obviously a short trade, right? We went for the gap fill on the downside. The option contracts that I went with was around 150 contracts. Each contract was roughly around $110, bringing my total cost around $16,500 on this trade. Now, when I'm trading 0DT, there's a couple of things that you have to keep in mind. One is Theta is very, very aggressive, which means you tend to lose value on your contracts much quicker than usual days. Second thing, which a lot of people don't mention or realize, is something called the IV crush, right? So when you're trading on Monday, Tuesday, Wednesday, the IV crush is not that aggressive. IV crush tend to happen towards the end of your expiration, which is on Friday, or usually when it's overexpanded, which is around earnings or around a major event. So for this is just the 0DT IB crush, and you guys can see that the entry time was around 9:43, and we held the trade for roughly a little bit over an hour. And I'm going to break down why I closed the trade, even though that it did not trigger my stop. Usually hold my trades until my stop is triggered, but unless if it's 0DT, and I'm going to explain why this trade I ended up closing a little bit earlier, all right? So just to kind of show you guys the chart, Oracle gapped up from 160, 162 all the way to 174 pre-market. And then going into the open, we hit 174.85 and we pulled back. So I was looking at this to pretty much get over either 175 for an upside entry or for the downside under the 170 level, right? So 170, we have a gap all the way down to 161. Now, yes, you guys can see the pre-market price action, so the gap isn't going to be that obvious, but you guys see here, this is the gap, right? So pre-market, this is an example of a gap. So this particular day, we gapped up all the way to around this level, and then we pushed up and pre-market to 174.85, and then we pulled back. So usually what I look for is when a level is tested, right? In this case, we went as high as 174.85, going at the open, we pulled back. So at this point, when it's pulling back, there's no entry for us because for momentum to come in, we want to wait for the stock to get closer to that level. So in this case, it's 175, and we never really reached that level. And then the second is the downside entry for us is going to be the gap fill under 170. So I try to go into the market without having any bias. I typically just have levels for upside and downside, and depending on what side has more volume or a high probability, I look to take the trade. And that's why we went out after Oracle for the downside. Now, it was a slight late entry. My entry should have been around the close of 170, but my alert came in a little bit late, so I looked at the trade slightly later than usual. So we got in right here with 150 contracts, averaging around $1.10, and our starting stop loss was $170. And as it pushed down, you guys can see we took our first scale out position, which is around 75 contracts at $1.44. Now, the reason why I scale out or implement scaling out in my trading is because you can hold your trade for a much longer period of time if you scale out. And secondly, on 0DTE, the options tend to lose value very, very quick. And that's where my exit kind of comes in, right? So I took half of my position out of 150 contracts, closed 75 here. And you can also see that going into the downside, volume after these three candles, the momentum kind of slowed down, right? And at this point, once we closed under 168, once it closed under 167, I increased my stop to 167, right? And the thing about options and 0DTs, as long as your stock is below your stop, you can hold. And one thing about the stop losses is once the stock becomes under your strike, meaning if it's the puts and you start trading at 164, you get more comfortable holding it. But here we were still not under that 165 level, right? So when we finally get under 165 on this candle around 1010, this is where I take out the remaining half of my position. So at 75 contracts, so roughly around 35 contracts, around $1.59. All right, and I kept my stop at 166. So as long as we do not close above that, you guys can see that we did absolutely nothing. We just held that position. And we were slowly making our way down to new lows. Now, at this point here was where the contracts kind of hit somewhat of a peak, and we went all the way to $1.90, right? Remember, we got in at $1.10. Now we're up almost 80 cents on our runner. So here I took another 20 contracts out, and I kept holding it because at this point, we're under 165. We increased our stop to 165. And since it's in the money, we don't really have to close the trade. But what started to happen is these pullbacks started to cause the premiums to lose value. So at the end, when I saw that the premiums had started to dip under 150, that's when I decided, all right, I'm going to close the trade, because if this thing goes over 165, Theta and IV Crush is going to eat up the remaining profits that I might have on the runners. So the remaining 20 contracts, we closed right here. Now, based on my entry, right, my stop loss was 85 cents, which would have triggered if we had given up the 170 level, and the risk was around $37.50. So if I was wrong, I would be giving back $3,750. So when you're going into these trades, make sure you have a preset stop loss and implement scaling out. Scaling out really, really helps you hold your trades as long as possible. Majority of the big wins that I have, like 300%, 400%, this is exactly how I scale out on those. And on SPX, because there's 0DT, the further away the stock price gets from your strike in your favor, of course, meaning if 165 is our strike here on Oracle, and this pushes all the way down to 160, I would have held this trade until the end of the day, right? But because it was still very close, I closed the trade. And with SPX, usually we see candles like this, and that's why you see that we tend to hold those trades easier for a longer period of time, because once the momentum comes into SPX, the drop is very aggressive. So I will be doing trade recaps for you guys on SPX as well. I know a lot of you guys have asked, but this was the last trade I took that I actually held for quite some time on Friday. So I decided to do a trade recap on this, and a lot of people asked about this specific trade. So let me know what other videos you guys want to see, and I will see you guys in the next video.